Market risk pertains to securities that financial institutions hold for trading rather than holding for the long term. The textbook defines it pretty well. I can't really improve on it, that market risk emphasizes the risk to financial institutions that actively trade assets and liabilities and derivatives rather than hold them for a long-term investment, funding, or hedging purposes. So you could think of the kinds of activities we're talking about here where the institution is trying to take advantage of really buying low and selling high. And so this would be assets that would be traded, have an intention of being traded probably within 1 year, as opposed to making a loan to a borrower and then just wait for the borrower to make their payments over and then make a year return over a long period of time, or owning a security like a treasury bond and wait to receive the coupons and then the par value. And if the financial institution were to sell the bond, it's not because they're making a bet about what direction interest rates are going to go. The trading portfolio, on the other hand, would be if we're talking about a bond, the bank buying a bond for the purpose of taking advantage of expecting interest rates to fall. And that would involve a lot more risk, particularly market risk, because the bank is exposing itself to how the market values that security from day to day. The different kinds of trading activities, very broad ones that we would especially consider this semester, would be foreign exchange. So if a bank or financial institution invests in currencies, fixed income securities, so that's the broad category that bonds would be in. That would also include mortgage-backed securities, and then equities. Now, especially U.S. banks are very limited in how much they can invest in equities. So that's going to be, there's going to be some restriction on how much the bank can do it. Now, the bank's affiliate, basically it's investment banking affiliate owned by the same parent holding company, might be doing, it's obviously going to have a big portfolio of equities. But if we're talking about a depository institution like a commercial bank, they'll be definitely limited by regulation in how much equities they will be able to own. Now, the way that market risk is most commonly measured is with this measure called daily earnings at risk. And the daily earnings at risk, it would be calculated by taking the dollar position that the institution has in a particular asset, and you multiply it by the VAR, value at risk, as expressed as a percent. Now, the value at risk, by definition, has to be set at some cutoff, X. Right? So the R stands for risk, value at risk, and it's the worst X% move in the value of the position, so worst for the institution. Now, one way we can try to measure daily earnings at risk is to assume a normal distribution. And so you could estimate the standard deviation from historical data and then identify the value at the normal distribution with that standard deviation, assuming a mean 0, because remember, we're talking about daily fluctuations. So if we're making bets about where stocks or a fixed income security or a currency is going to move from day to day, the average change on a day basis is going to be about 0. So then there's all just volatility around that. And if we're talking about the 1% level, which is the level that our textbook emphasizes, and so we'll be using primarily, the cutoff on the normal distribution is 2.33 times the standard deviation. So what that means is that if I have the normal distribution here, and this represents the normal distribution, and I have, let's say, the different returns on the x-axis, this is the probability density function there. We're going to assume that the mean mu is 0. There's going to be some standard deviation here that, and if we go out 2.33 standard deviations either direction, that is basically the rough cutoff for the 1% probability that the return will be in either of these tails. Right, so this 2.33 is a cutoff that the textbook uses over and over again, and we will use especially when we're doing problems from the textbook. We're going to just use that level, not the whatever more precise level we might get from looking up a standard normal table or using an Excel function. Another way that we could estimate this worst 1% in either direction, depending on what's worse for this position we have, is to just calculate it directly. Now, the advantage of doing that method is that it does not require a normal assumption, or really actually more generally, it doesn't require any distributional assumption. Doesn't require any distribution assumption. I'm going to use this. Prepared for us here is the yield to maturity change, relative change, that is, relative change. So see the word there, relative. So if you recall, we defined relative change as so the relative change in the rate is the delta R, where R is the rate, over 1 plus the original rate. And that's going to be advantageous to us later because we're going to use the duration approximation method of percent change in price. So, so on January 1st, 2000, it's saying that the yield to maturity on the 10-year, and this is a 10-year zero coupon bond, went down by the change divided by 1 plus the rate from the previous day was negative 0.08%. So the interest rate went down, the value of the bond went up that day. And then we have the value of the euros, the percent change in the value of the euro. And in the previous lecture, we talked about foreign exchange and how to interpret that. So from that, you know that on January 1st, 2000, this is telling us that the euro went up in value by 1.52% that day. And so we have this going all the way up through October of 2019. So a good amount of days of data here. I'm going to move over now to just calculate some basic statistics. You will calculate most of these statistics in your quiz that you'll take after watching this, so pay attention. So the way you calculate the mean is pretty simple. It's the average function, and then you can, for a lot of these functions, you can include the label there and just click on the column, and we get the mean. And so remember what I was saying, that we don't expect these changes to be that great on average from day to day. So this is practically 0, so it just basically gives us this assurance that we can presume later on that there's a 0 change on average in what we would expect in the future. The standard deviation, let's use the standard deviation of a sample function. So your function to use is stdev.s. Select the column again, and we see the standard deviation relative to that mean is significantly higher, so 0.0547%. We're not going to use the minimum and maximum in any of these calculations, but I think it's interesting to just report it. So this is telling us that the relative change in yields, the lowest it went down in one day was 0.5%, percentage point, and the most it went up in a single day was 1/4 of a percentage point. All right, now this is probably stuff that you have done before in some other course when you've worked with returns, basic statistics. Now let's talk about the value at risk on the percentage basis, and then we'll use that to calculate the daily earnings at risk. One way we can do it, so this is just one way, is using the historical data. And so the way you would do that is use the percentile function, and they used to just call it percentile, but then you have to expand on it to do .inc. It doesn't really have much of a big difference. Now when you do the percentile function, we'll select the column, and then we'll ask what's the worst 1%. All right, now pay close attention. If we're talking about the interest rate changing and you own the bond, ask yourself, or say right out loud, what is bad for you? That interest rates go down or they go up? And the answer is when they go up. Because remember, when you own a bond and the interest rates go up, the price of the bond goes down. So we will care about what the upper tail is in the change in the interest rate. So I'm going to put 99% there as my percentile. And so the worst 1% change was 0.1439%. So there's some date here over the past over almost 10 years, or actually 20 years, that and 1% of the cases, 1% of the days out of the almost 2 decades, the interest rates went up by more than 0.1439%. Now, if we did not want to use the historical data and really believe that as we think about the future, we want to assume a normal distribution, we can use the norm.inv, the inverse of the normal function here, and that will tell us the cutoff that gives us that 99% probability. So we're going to put in 99%, and because this is more theoretical about the future, we're going to just impose 0% to say that there's no reason for us to think that on average the interest rate will jump up or down on a given day. But we know that there's volatility, and we will use the standard deviation here. Now this is going to be a little different than the answer you'll get if you multiply it by 2.33, and actually it would be a good exercise for you to compare what would the number be if you multiplied the standard deviation here by 2.33. It would be close to this, but not exact. But this is telling us here that for a distribution that has a mean of 0 and a standard deviation of 0.0547%, there's a 1% chance that the relative interest rates will be equal to or greater than 0.1271%. So we see we have slightly different estimates there of what the worst 1% is using historical data versus imposing this normal assumption and a mean of 0. So once you do it for all of the fixed, for the interest rates, we can just copy and paste the first 4 to do the same for the euro. So we see the average change was also about 0. Now, when we own the euro, things will be a bit more intuitive because we are now directly saying if we own euros, what's bad? Of course, what's bad is that the value of the euro goes down. So when we do the historical worst percent, we'll use the percentile function, select the euro, and put in 1%. Right? So now we want the lower tail. So 1% of the time over the last 20 years, the euro went down by 1.55% or worse. And if we assume the normal distribution, we use that norm.inv function, and we would put in 1% as our probability because we're worried about the lower tail. We're going to impose a 0% mean and select standard deviation there. And so we get a little bit of a different answer that we assume normality, that 1% of the time it will be less than or equal to negative 1.4%. I think one takeaway from all of this data is that if we look historically, there's more frequency of bad events than would be implied by imposing the normal distribution, which gives a little indication that the distribution might not be truly normal, that there could be some what's called fatness in the tails. All right, I'm going to move over now to show how you would calculate the daily earnings at risk. We're going to assume that the financial institution has $1 million in treasury bonds right now and $1 million in euros. And we want to figure out what's the daily earnings at risk for both under either assumptions. Now, to do the treasury bonds, we have to make a modification here, and that's using the duration approximation. So let's just let me just remind us all about that. So remember what we learned in interest rate risk, that the percent change in the price is approximately this, where the D stands for duration. Now this here is the relative change. So all I have to do is multiply the relative change by the duration of the bond, and I'd have the approximate. Because these are 10-year zero coupon bonds, the duration is 10. And we will take the worst change here. Now, technically, so let me remind you that we'll apply it by the position. So the position we have in treasury bonds is $1 billion, and that tells us that in a given day there's a 1% chance that we will lose $14 million in this position in market value. Now, the daily earnings at risk is because in the term it says at risk. That's really a magnitude. So I'll put an absolute value function around that. Now you might realize, well, why didn't you just not put the negative to begin with? It's because I want to tie in what we're doing with what we've done before to remind you that if interest rates go up, the value of the bonds are going down. And then we can do something, and then we just basically do the same thing, assuming the normal. So we can now just copy and paste that one down. And not fix, let me fix the position, because that's why it was so low. And then we copy it again. What else did I miss? Oh, I fixed the wrong thing. So I'm going to fix the position. Then copy, paste, and so that would be that would be our estimate of the daily earnings at risk of our bond portfolio. Now the euros are going to be more straightforward because we already have the percent change in price here. So we will take if we scroll over to the left, we'll see that we're working with the right row there. The worst 1% historically has been negative 1.55%. We multiply it by the position of $1 billion worth of euros, and that would mean we would lose 15 million. And put an absolute value sign around it. Now, when you do this yourself, you can skip. You could put a minus sign to reverse it, so you can see a positive number. But because I'm explaining it to you, I want you to understand that you can't just reverse a sign wherever you feel like it. There's a reason why my numbers are positive, because we are already defining this number as an amount that's at risk. And just copy and paste that one down. And so these are the amounts that we believe are at risk in any given day that has some reasonable probability, though it's low, that we could lose this amount or actually more in a given day in any one of these positions. And we would have to make an assumption, though. Do we want to make assume that the 1% is based on historical frequency of returns without imposing any distributional assumptions, or do we want to impose a distributional assumption for the future just based on the standard deviation we've observed in the past, and then that would be it. Now, if you want to choose which one to use, you might want to go more conservative and then take the historical, since it does to me seem to vary quite significantly, especially when you're talking about $2 million. It seems like a lot of money. You might want to go with the historical method. While I'm on the topic here, we'll come back to this later, but if you have a portfolio of both, we're going to see that the daily earnings at risk of the combined position isn't just the sum of the individual ones, and that's because you can get a diversification benefit from owning bonds and euros. So let's just see what the correlation is between interest rate movements and euros. So we use the Correl function. We're going to select the interest rate movements, and then we're going to select the euro movements, and that gives us a correlation of negative 0.06. So that tells us that it's pretty close to zero, that when U.S. interest rates change, it's really doesn't have much to do with the euro changing, though there's a weak correlation negatively that when the interest rates in the U.S. go down, the euro goes up by a little bit, and if you take an international finance, you could see why that would make sense, why it was negative. But let's go back to our document here. Okay, so you have this daily earnings at risk number. Now, you might want to not only know what could we stand to lose in a given day, but what could we stand to lose over several days, like a week, over n days. So, particularly now, this is being recorded during April of 2020, where there's a tremendous amount of volatility, and we're seeing the market can go down for significantly several days in a row. We might want to know how much could we stand to lose over a select period of time. And the way you would do that, and the textbook calls that VAR, which in a dollar sense, okay? So daily earnings at risk is indeed a value at risk as well, but it's specifically over one day, and then they save VAR for more generally any end period days. And just to differentiate, I used a little a when I talked about it in a percent sense earlier. So the formula for the daily earnings at risk over n days is simply the daily earnings at risk times the square root of n, and that just has, why it's a square root is because of just statistics. It has to do with standard deviation, variance, standard deviation. Just recall that, something to do with a square root. I think that's sufficient. So, for example, if you looked at our Excel file here, we had calculated that the euro, if we looked at it historically, the value at risk for the euro is $15.5 million. The VAR over 5 days for the euro is the daily earnings at risk. If you rewind and you see that it was $15.5 million times the square root of 5, which equals $34,690,594. All right, so that would be the 5-day earnings, 5-day amount that's at risk. Now, why it's not times 5? Well, you have to remember there's volatility, so there could be days when it's going to go up. So at the 1% level, you could expect over 5 days to lose this much, $34 million. All right, let's do several examples that would be of the sort you would see in a textbook or an exam. A bit more maybe on the easy side. Let's say a bank has $1 million worth of yen, and the standard deviation in the yen in terms of dollars over the last 500 days was 0.4%. So read this very carefully. It's saying that the standard deviation is 0.4%, not the 1% worst changes. So to calculate the daily earnings at risk, we need to first find the 1% level. So remember that's 2.33 times 0.4%, and that's when it goes down. So 2.33 times 0.4 is 0.932. So if we assume the normal distribution and that standard deviation, we'd expect the euro to go down by 0.932%, 1% of the time in one day. And so then to calculate the daily earnings at risk, we'll take the position, so $1 million worth of yen, and then multiply it by how much we could lose. So remember now that I'm using it in a formula and I'm multiplying, I have to convert it to the decimal. I'm taking the absolute value, and so we get that we could lose $932,000 in our position on yen in a given day. The amount that we can lose over a 5-day period from our yen position would be the square root of 5 times the daily earnings at risk, and that gives us, we could lose $20,840.15 from our position in yen in a given day. I'm sorry, in a given 5 days. All right, now let's do a fixed income problem. Here we're told what the standard deviation interest rate changes are. So we're not being told the standard deviation in the price of the bond, but just the interest rate. So as you recall, that we can use the duration approximation method to figure out how much the price would change. And so remember that formula was this: the percent change in the price is roughly minus or negative the duration times the change in the interest rate over 1 plus r. This duration over 1 plus r was called the modified duration. So let's calculate that right now. So the modified duration is d over 1 plus r. It's a 0 coupon bond, so the duration would be 20. The interest rate is right now 3%. So we have a modified duration of 19.4175. So we're going to use that to calculate the percent change in the price. Now, so what we'll do is take the Alright, so let's calculate the 1% worst change in the price. So what we'll do is use this formula here, percent change in the price, and we'll start with minus this modified duration that we calculated above times the 1% worst change. So we're going to multiply by the delta R. Now the delta R will be 2.33, so that's the 1% cutoff, times the standard deviation that was given of 0.1%, and that equals negative 4.524% is the worst 1% change. Then we're going to apply that to calculate our daily earnings at risk. So the amount that's in our of bonds that is owned is $1 million worth of bonds. Multiply that by the 1% level change, and here's where I'll eliminate the negative because this is already defined as a loss because it's at risk. And we get that we could lose in one day because of interest rate changes $45,000 there in the value of our bond or worse on our worst 1% days. If we did the 5-day value at risk, that would be the daily, so that's an important number, that's our DER, and then the value at risk over 5 days would be the daily earnings at risk times the square root of 5, and that would say that our worst 5 days in a row could be a cumulative loss of $101,000 out of the $1 million. So that's quite a bit, just even though 0.1% change in the interest rate might not, a standard deviation may not seem that much, that does imply this possibility of losing that much over in a one-day period in the value of your bond. All right, now up to this point we've been talking about daily earnings at risk per position, but remember, we've been discussing over and over again in finance, what it really matters is the value of your entire portfolio, and therefore you should really only care about the risk of the portfolio as a whole, not in pieces. So we have a formula here for how you would calculate the daily earnings at risk of an entire portfolio of assets. So the portfolio is being represented with a P here. That's why the P is there, daily earnings at risk of the portfolio. And our textbook gives us the formula for more than 2. So I think that's good for us because typically we only do 2. And it's actually doesn't seem as bad as when we do things we're talking about percentages or rates, because it's really just additive that, as we add the daily earnings at risk of each position, we are increasing the size of our total portfolio. So the first thing you do is we're going to do the variances first, and then we have to do all of the cross terms. So then 2 times the daily earnings at risk of asset X, daily earnings at risk of asset Y, and then the correlation between X and Y, and you have to do, let me not put a times there just because we already have an X. That might be confusing. You all know that that's times daily earnings at risk of Y. So we have to do all the pairs. And 2 times each one of them, so the last pair we have would be X and Z. And now that would be the variance of the daily earnings at risk, and so then you'd have to take the square root of all of that. And so again, where rho with the 2 subscripts is just meaning the correlation of assets 1 and 2, the Greek letter rho. All right, to not make this video too long, I'll hold off on an example on this. We can save doing work with this formula for the live class, but it is very similar to what you've seen before when you do the standard deviation in returns of a portfolio. This is standard deviation also, well, not exactly standard deviation, it's whatever that 1% cutoff is times standard deviation for daily earnings at risk. So it's definitely related to that formula. Now, our discussion here on the portfolio means that the daily earnings at risk of the entire portfolio cannot simply be the sum of the individual assets' daily earnings at risk. And the other thing to recognize, though, is that the daily earnings at risk of the portfolio is highly sensitive to any assumption you make about correlation of the assets. Right? That can make a significant impact. Now, some articles that I highly recommend that you read that's in the supplemental readings are about this incident that had occurred where a trader at JP Morgan, and he has this, it's been known as the London Whale, so it was in their London office. He had been making all these bets on some very, it's definitely much more complicated and instruments than what we're dealing with in the textbook examples, but usually it's involving derivatives, and I believe this with him it was involving credit default swaps, but he was trading these assets, and he lost $2 billion in one day. So $2 worth of trading losses in one day. And so this has been something that's been studied a lot since then about how this occurred, and there's many reasons why it occurred. It was a failure of risk management at the level above him that should have prevented a trader from doing this. But one big mistake that was made on the more technical level was that the daily earnings at risk was mismeasured or misestimated. And so the Wall Street Journal articles and then a very interesting blog post is on the main page. I highly recommend you reading it. We will come back to it, but it's very, very interesting, and there's a very strong caution for all of you who would go into finance, and because you can take the lessons from this and expand it. You might say, well, I'm never going to be trading securities like this. I'm going to do other things. But no matter what you do, you have to manage risk, and you have to be careful with your calculations. And a miscalculation can have significant consequences. When you're in school, I'll give you partial credit if you make a calculation error, even if the final answer is way off from the correct answer, because my concern is that you're understanding the concepts. But when you're dealing with actual dollars, there's no such thing as partial credit. You lose that money. So you have to make your calculations with accuracy and not without error. All right, now up to this point we've been making this assumption that if we can identify that 1% level, then that's sufficient. But remember when we were looking at the Excel data that over the last 20 years of both the euro and interest rate changes, that the historical 1% worst case was worse than what the normal distribution implied. And I think that that is indicative of there being more frequency out in those extreme ends of the tail than the normal distribution might be accounting for. And the normal distribution is an assumption. Well, what if we want to not use the assumption and take into account some more action that might be occurring in those tails? So that's where this new metric, or relatively new, it's becoming more used, is the expected shortfall. And so what the expected shortfall is what do you expect to lose on average on these really bad days, as opposed to value at risk, which is really what's the best outcome on a bad day. So the best of worst cases. Expected shortfall is the average of worst cases. So let me try to illustrate why this is important. So I'm going to make I just compare two distributions. Let's say that you have one distribution that looks like this, and this is your that's your 1% level. And let's say you have another distribution that, maybe it looks kind of similar out here, but basically there's kind of let's say it has a shape like this, but that there's actually when things are really bad, that can actually happen a bit more than would be implied by the blue distribution. And let's assume that the area is 1% here for both. All right, so both share this cutoff point. All right, so this is the value at risk at the 1% level as a percent. Well, the red distribution is worse than the blue distribution. I mean, we can see that there's this greater probability of really bad outcomes, and the expected shortfall would be able to capture the difference between the red and the blue. Now it's difficult, so therefore the definition of the expected shortfall, which is abbreviated ES, so just a reminder what the ES is standing for. It's standing for expected shortfall. So the expected ES is the expected shortfall, average value conditional on the value falling below the X% cutoff, usually 1%, especially in our textbook. But 5% would be a common one as well. So it is difficult to show this, or for me to give this to you on an exam question, and the textbook also difficult to it's difficult for the textbook to give you questions to calculate expected shortfall, because now it's not so simple where you can just simply multiply the standard normal 2.33 times standard deviation to then just get the 1% cutoff point. But you have to get this average within the tails, and we're not going to assume normality anymore anyway. or we don't have to. I think that the big application of expected shortfall is when you don't want to have to make this assumption about the distribution. So it's going to be a simple setup like this. So it's actually not too complicated to actually calculate expected shortfall for questions that I'll ask you in the course. Now let's say that we have two banks. We got Jekyll Bank and Hyde Bank, and they each have $1 billion in their trading portfolios. And so we're going to look at the entire portfolio's possible returns, and we're going to be very simplistic here and make these assumptions that there's a 1% chance that the return for Jekyll Bank will be 10%, and notice Hyde Bank is the same, right? So it's the same. They both have a 9% chance of returns being 7% or better. And this is really the return cutoffs. Right? So it's 9% between 7 and 10, 80% chance between 1 and 7. And so everything's the same here until we get to the worst 1%. And that's really what we care about anyway. On the upper end, they could actually be the same, and we wouldn't care when we're talking about risk. But notice that these are different. So let's calculate the daily earnings at risk at the 1% level and at and then also the expected shortfall. So both Jekyll and Hyde banks daily earnings at risk, where we're using the value at risk at the 1% level, will be the $1 billion times, and we see that for both, notice that this sums up to 1%. So they both share the same cutoff of 8%. So they both could stand to lose $80 million with one or worse 1% of the time. But the Jekyll expected shortfall is going to be 1 billion times right now. So this is the new part here. Notice that we have 0.6% of the time it will lose 8%. 0.4% of the time it will lose 13%. Now we want to get the average conditional on being in that lower 1% by the total probabilities within that worst 1%. So this is a conditional loss given being in the lower 1%, and that reduces to 10%. We calculated what's in the parentheses there, and so the expected shortfall that Jekyll Bank has is $100 million, whereas the Hyde Bank's expected shortfall is the same as the daily earnings at risk when we use the value at risk at the 1% level. So recall Hyde Bank was here, and there was really notice there was no action in the 1% level. It was just the 1% chance and negative 8%. And so the expected shortfall for Hyde Bank is the same as we'd calculated before. And so now by using the expected shortfall, we can differentiate between the two and recognize that Jekyll Bank has more to lose given it being a bad day than Hyde Bank does.